And with that, I'd like to welcome everybody to our July session of the Dashboard Diagnostics series. This is part of our portfolio design and management series of sessions where we basically take a look at real portfolios and try to extract some lessons. I'm joined here by Lori Fredrickson of Vivio, and Vivio has offered up many clubs to take a look at their portfolios and see what type of lessons we can learn. And just like to welcome back all the familiar names and faces that I see on tonight's roster, and then also a special welcome to anybody who may be joining us for the first time. We did start this series a couple of years ago where we basically do take club portfolios and look for lessons and stories that we can tell and learn from. Investment clubs from all over the nation have participated, and it's been a lot of fun. Tonight we are going to do a little bit different, a little special wrinkle. I'd love to hear from any or all of you on how much you like it or don't like it. But we thought what we'd do is just every 3 or 4 months maybe take a break from the investment club arena and take a look at a different sort of portfolio. And hence the comments about the Motley Fool and as we were saying just a few minutes ago. I have a little bit of background with these guys. I've worked with Tom and David since the mid-1990s. What you guys all need to know is they are extremely supportive, just like Lori was just talking about, when it comes to the individual investors and the investment club movement. They wrote columns for Better Investing magazine for several years. They presented at conferences. They came out to Chicago when I was involved with the chapter in Chicago, and just very supportive of everything that we do in this community as long-term investors. So tonight we're going to take a look at the performance of one of their newsletters, the Motley Fool Stock Advisor, and basically they just celebrated, as the screen shows, their 10th anniversary. We want to take a look at how well they've done over the 10 years or so, and let's just kind of dig in and see what we can notice, what we can learn. So again, a little bit of a departure, but really do love working with these guys. They're stone cold serious when they say they really want to do this for the education and for the enrichment and for the amusement. They do try to bring an element of fun, but again, just reinforcing what Lori just had to say, they do take this stuff seriously, and they are among one of my favorites when it comes to being serious and actually tracking the results and the performance results of that which we do, and I have a lot of respect for that also. A little bit of housekeeping. Again, no investment recommendation is intended here tonight. This is all about education. Anything we talk about literally is not an investment recommendation, whether it's myself or Lori or anything that's brought to you via the Motley Fools. Do your own homework. So we're going to talk about the Motley Fool Stock Advisor newsletter. Perhaps some of you are actually subscribers. I've been a subscriber for quite some time. Like I said, I go back to the original days with when these guys were first launching their newsletters. This particular newsletter is considered the flagship of the newsletters that they put out. As most of you probably also know, they have a whole bunch of different newsletters. I'm not so much sure what I think about having all those different newsletters. Obviously, we don't do it that way at Manifest Investing, but this is considered the flagship of their fleet of investment newsletters. When you stack them up over time, you can see that their annualized rate of return, we're going to dig into this quite a bit deeper, their annualized rate of return is 7%, approximately 7%, during a period of time over the last 10 years or so when the Wilshire 5000 or the total stock market index has advanced only 4% or so. So their relative return taken in aggregate is somewhere in the neighborhood of about positive 3%. Now again, that's going to look like a lower number than you'll see in some of the advertising, and they do what a lot of the people in the newsletter business do. They don't annualize the numbers. And in order to put everybody on a common footing, common ground at Manifest Investing, you know that we annualize everything. We annualize every individual investment that we keep track of, and that's all part of just keeping it annualized and keeping it all on a very common perspective. And we'll see how they stack up here in a few minutes. Here's a look at the newsletter, and again, I don't work for these guys. They don't pay me to do this. Their newsletter is, could be perceived as a potential competitor to Manifest Investing. I mean, if you're out there in the realm of trying to collect information about investing, $199 a year may sound a little bit steep to some of you, but I do find it to be quite a value, depending again on how many assets you're trying to take care of in terms of total amount of dollars. And this can actually be cheap for some people if it's a source of really good ideas. And we'll get into how good that is. Here's that number that we were just talking about. If you don't annualize the number actually looks quite a bit better, and that's why people who try to sell newsletters do it that way. They're not the only ones. If you do want more information on their particular newsletters, including the Stock Advisor, you can go to that link in the center of your screen. Again, as you guys all know, I'll make these slides available. You can either send me an email or it'll be posted in the manifest form, so you don't have to worry about keeping notes. I would like to point out that the second cover story that we had for Manifest Investing did feature an article by David Gardner back in April 2005. It was a tribute to Foolish Investing in celebration of their national holiday, April Fool's Day, and it starts off with the words "Once Upon a Time," and I really like it. Go back and take a look at that if you want to review what I'm talking about. But again, as we were talking about before we got started here tonight, they are a voice. They're an advocate for the individual investor, and they really do try to do a good job of watching out for us. And just as an example, they were staunch advocates, very, very heavily involved in the fair disclosure stuff that went on 5 to 10 years ago. For those of you that are not familiar with this, there was a time when the brokers and the big institutional investors could get together with their largest clients and basically do a form of selective disclosure, basically sharing what would probably be deemed insider information today. And they basically held up their hand and said, you know what, if you guys are releasing public information about any companies and analysts, you guys just simply have to release that to the total world. And it became known as regulation fair disclosure, full disclosure, whatever. And they played a very significant role in getting that done. So again, they take this stuff pretty seriously. We're going to talk about it from the perspective of a little bit of friendly competition that goes on brother to brother. That's David on the left, Tom on the right, and we're actually going to break the Stock Advisor as they do. They break the Stock Advisor newsletter services into two baskets. Some people would regard David as the rule breaker, Tom as the rule maker, and we'll see as we take a look at the portfolios, as we, how we look at Dashboard Diagnostics, you can actually see the difference in styles between the two of them. And as you can see over these 10 years or so, I'm just going to put this in a nutshell. Because Tom would be more likely, based on his style and his approach to investing, to be more fully invested in the S&P 500 type stocks, the stalwarts, the bluer chip companies. With the last decade, Tom has been at a relative disadvantage. David invests in pretty frisky stuff, some stuff that'll set your hair on fire, and he's been quite good at it, achieving a relative return somewhere between 2 and 3%, while Tom has been hovering down north of zero, which is important. We're going to get more into that here in a second. But both of them positive, but David has a slight advantage after 10 years. When it comes to the accuracy of their predictions, you can see they're both hovering somewhere around the 50% range. They have taken a bit of a hit here in the last few months. Some of their major positions, like in Netflix, Quality Systems, a few others, have actually put a little bit of a dent in their long-term results here within the last 3 to 6 months. And again, given this a little bit of context, the average investor, based on our research and studies, is actually down here off the page, somewhere down around 40%, perhaps 35 to 40%. And what the outperformance accuracy is it's a gauge of how the investment does from the time of selection versus a stock market benchmark. In this case, we use the Wilshire 5000. So we basically, each one, so if a company outperforms, a stock when it's selected, outperforms the Wilshire benchmark, it basically gets a winning condition, and we basically add up the number of wins versus the number of wins and losses, and that's where the percentage comes from. So again, you can see David is up around 50. Tom is just a little bit south of 50. Lori, any questions at this point or any comments? I thought I heard.
I don't see any, Mark.
Okay, I thought you were maybe threatening to chime in there. It's something about the fair disclosure, right? Full disclosure. Whatever.
Oh, well, that's just the kind of thing they do that I really think is great.
Yeah, and they were big when it came to addressing that situation. Absolutely. Okay, let's go ahead and press on. Again, the floor is open. If you see something that you have a comment or question on, we are willing to address them as we go. Again, many of you are very familiar with some of the scoring we've been doing, but we do want to put the numbers that we're talking about here in context because they seem kind of small. We've got to put them in context. Again, one of the best relative returns, again, relative return is the performance of the portfolio versus the benchmark. In the case of Peter Lynch at Fidelity Magellan, over the time frame shown, about a 13-year time frame, he achieved one of the best returns from a relative return standpoint in the history of investing. There's only a few that I can think of that are even threatening to be anywhere near that. We do, by the way, know of a few investment clubs that are in the 10% type range. We'll talk about that more in a minute. Again, going on over a longer term perspective, if you want to talk about the last 20 years for Warren Buffett and Berkshire Hathaway, this is Mr. Buffett here at front and center, they've achieved about a 6.6% relative return going a little bit more than 20 years. So now Dave and Tom here at between 0 and 4% over 10 years, that may not seem like much, but we're going to put that into perspective also, again, by pointing out when it comes to the field, total field of people trying to do this stuff, how rare it actually is to end up positive. And it's very important to keep that in context because it is fairly rare. Many of us here do it, but it's fairly rare. We have to keep that in mind. This is a little bit of a busy slide, but I think it begins to make the point. What you're looking at here is that same type of information, only more samples. And what we're basically looking at here is a bunch of institutional portfolios. Most of them are going to be actively managed mutual funds, or in some cases now exchange-traded funds. And the ones in red are, as we said here with Peter Lynch and Fidelity Magellan up here off the chart. A couple other ones that are up here towards the top. Here's a privately managed portfolio, basically a hedge fund, run by a guy by the name of Walter Schloss. So again, you see very few points up here north of 5%. The blue dots, by the way, are investment clubs or groups or partnerships of investors within our community. So some of these blue dots are actually in pretty good standing also. Now you can see that the red dots begin to fill in below the 5%, and then they begin to actually pop up with more frequency when you go sub-zero. Again, anything below 0 would be an entity or a fund, a portfolio that is underperforming the stock market. So you can, again, start to get the point. Notice that Dave and Tom are right in the heart of the more successful portfolios over that period of time. And again, I think they've probably come down based on some of the pressures in the portfolio. When you see some of the holdings, you'll know exactly what I mean by that. I think they'll probably drift back up as their performance continues to be strong over the longer term. We did kind of catch them at a kind of a weak moment, I think, at least in my opinion. Now, a couple other things I'd like to make clear. Two things. The first one, the return experienced by an average investor, according to a study by Dalbar. Again, we've talked about this before, but again, the average investor with performance chasing and all the other things that we do when we behave badly as when we're human in our investing or fall victim to an abundance of emotion, etc., the average investor between the period 1992 to 2012 actually achieved a return of -5% to the stock market benchmark. And again, these are average investors. And then the other thing I like to point out is the red dots on this screen are actually biased to the upside because we started with the most successful mutual funds and the most widely held mutual funds. If we plopped another 100 mutual funds chosen at random onto this page, the vast majority of them, 80 to 90% of them, would end up within this cloud. And literally only 10 to 20% of them would end up somewhere in this range. So again, all of those things are important to keep all of this in perspective. The performance of the clubs that we see noted here, many of these are chapter sponsored model clubs, and the light blue dots are some of the portfolios that manifest investing, like Solomon Select, Tin Cup, etc. So again, keep that in perspective. And again, the Motley Fool Stock Advisor, broken down into the two pieces, rule breakers and rule makers, have been quite successful. Let's take a look at the rule makers first. Again, this would be Tom Gardner's, the more conservative, the more risk-averse brother of the two. And when you take a look at the construction of the Rulemaker portfolio, you can see that, again, if this were a club that we were looking at, we would say, well, this is maybe a little bit light. This 11% is taking care of and selecting companies for the newsletter. We would hope that they would be trying to fill in this gap, identify higher return opportunities to close this gap because they're a little bit light. Quality, kind of at the low end of the extreme. Again, people within our community generally have no trouble hitting this target range of being in that 70 to 80 or so range. And Tom's portfolio is just a little bit light, not bad, just a little bit light. When it comes to growth, the fact that he is more conservative and does deal with some of the larger stalwart type companies, just a tiny bit light on the overall growth of the portfolio. There's a few larger companies in the portfolio. He is willing to go to any size or any growth rate type company, and you can see that maybe a little bit light there also. The PE ratio at 17.5 checks in as fairly conventional, as well as the yield, and then financial strength and EPS stability ratings that are fairly consistent, maybe a shade light, just a shade lighter than what we typically experience. Flipping the deck to David Gardner, a little bit more feisty, a lot more frisky. You can see that his return's a little bit higher at 12.9. It's still not quite up to the target range of 14 to 19%, and you can see that he's obviously much friskier than the average portfolio that we take a look at. We don't see too many that are down in here, and that's because he is willing to invest in more non-core, and many times that non-core will be very early emerging life cycle type companies, very early in their corporate life cycle, and he's willing to go there and invest in those type of companies despite the roller coaster ride that he sometimes will be subjecting himself to, and that actually shows up here also. 13.8% growth means that he is invested in some smaller companies, maybe a little bit higher concentration than what we're generally used to. That also comes to bear when you talk about the PE ratio being higher than 20. Obviously cares less for yield than his brother. Financial strength is still fairly important, but again, with his willingness to pursue some of the more non-core, less traditional companies, he's looking at basically companies that have average stability overall, and we generally like to live a little bit north of that. So there you have it, the two side by side. David a little friskier, maybe a little bit more reminiscent of some of the all-male investment clubs that we've visited over the years, and just because you're frisky doesn't mean you can't be successful. Here's the two portfolios side by side, and I don't think I have to put any graphics on here as to whose is who. The one on the left is the more conservative one, Tom. It's actually spread out very well on a sector basis. Not too much concentration in any one sector. Tom Gardner's Rulemaker portfolio has a little bit of an emphasis on healthcare, but there have been some wonderful opportunities over the last 2 to 4 years in that realm, so I'm not surprised to see him end up there. He's got some investments that go back several years. You're going to hear more about quality systems, maybe a little bit on one of the healthcare providers also. Here you can see on the right-hand side that David is not constrained by slices of pie. He's willing to go with a pretty heavy dose of discretionary and a pretty heavy dose of technology. And, oh, by the way, that is a testimonial that David talking about manifest investing. So, you know, we know Tom is a pretty good dancer, pretty smart. We like him a lot. But, you know, if David's going to keep saying things like that, we're going to be cheering for him. Here's a look at Tom's portfolio subjected to a dashboard following these going back 10 years. You can see that the overpowering position in the portfolio in terms of percent of total assets is quality systems. Quality systems has been in the portfolio for quite some time. We're going to look at that in greater detail. I do note with interest that quality systems has been talked about fairly extensively on the Manifest Forum, and in fact it came up for a fairly lengthy discussion at the Challenge Club meeting just 2 nights ago. So you can take a look at either one of those two things. One of the things I have done for you here is, just as we do with all of our dashboards where there have been repeat selections, keep in mind that anytime they're picked in one of these tracking portfolios, we invest $100 into the company. So in the case of QSII, Quality Systems, that's it's been selected twice, so $200 has been invested in Quality Systems. Again, we're going to talk more specifically about when and where, but you can see that that $200 has grown to be nearly $2,200, and that's down significantly from where it was. So pretty cool selection. Some pretty good track records with companies like Berkshire Hathaway. Coventry Healthcare also goes back quite a time frame. He's also a fan of Dolby Labs. Both brothers select Netflix in their portfolio, interestingly enough. They both ended up with a little bit of Netflix in there, and I believe that's a single-time selection for Tom, as we see there, so not too shabby. $100 has become nearly $500 in Netflix. But you get the idea. One of his more recent selections, we'll be talking towards the end of the session about the things that they seem to like more these days, is one that we actually liked 2 nights ago for the Challenge Club, Coach. Coach is a selection that's actually been made 3 times by this portfolio, so $300 invested in Coach is up to $424. It was selected by Tom, I believe, as recently as a month ago, and I think you can see why over here. Very high quality. One of the higher projected returns on the whole sheet, as many of you know, Coach has actually come back a little bit in price, so it becomes one of the more attractive positions if you're going to do a reselection or a repeat selection in this portfolio. Moody's has also been in Tom's portfolio since the very early days of the Stock Advisor newsletter. So again, there's your positions top to bottom, some of the larger positions based on how they've done, along with the frequency of the number of times of selection. You can see some other favorites down here. Here's one on the end, Aflac. It's been selected a couple times. And some fairly traditional, many of them would be considered core investments by many of us. Well, here's the rule breaker version of David Gardner's approach to the portfolio, again with the repeat selections down at the bottom. I would characterize David as quite adventuresome, quite, in some cases, a bit adolescent, and I mean that in a very respectful way. I mean, he's a dreamer, visionary. He likes video games. He has a soft spot in his heart for Disney. Notice that Disney shows up here fourth on the list, and it's been selected 5 times. So $500 invested in Disney has become almost $1,400. And you can see there have been multiple selections in a number of cases. How about Apple 3 times over? Apple shows up here in the portfolio. How about the internet company in China, SINA, or Sina? I'm not sure how you pronounce it, but there it is. But you can see his fascination with video gaming, regular games here with Hasbro. Like I say, it's a playfulness. It's kind of fun, along with these internet-based companies that, again, when you take a look at the numbers, have all performed pretty well. In the case of Netflix, it's been selected at least 4 times. It may have actually been selected 5, and he may have sold a position. We'll take a look at that in a few minutes. But this is how we get a little bit more growth, a little bit less stability in the portfolio, and a little bit less quality because these companies are, in some cases, relatively unproven, and they're dragging the number down. He is also willing to go after some companies that are more cyclical, and that, as we said before, non-core, so that'll drag some of those numbers down a little bit. As we get towards the end again tonight, we're going to see a little bit of we'll talk about Priceline. It's had some pretty decent results here of late, and that one will definitely come up, and there's probably a couple others. He did mention eBay fairly recently also. So you can see, again, fairly high quality, fairly high differentiated return forecast for the rule breaker portfolio. So again, probably a little bit more frisky, a little bit less like some of our more traditional portfolios, but a source of ideas when you're looking for something with a little bit more hot sauce involved. With that, Lori, before we go in to take a look at their history of selections, any questions on the floor at this point? Anybody have a comment or a question?
don't see any, and I don't see any hands up right now.
Quiet audience tonight. That's okay. As you can tell, we're kind of cranking through a bunch of slides. So we'll keep pressing on. If anything comes up, people feel free to jump in. Let's go ahead and jump to the scorecard portion of the session. We're going to talk about Tom's Best, starting with Tom's Best. And what I've done here is taken the actual individual transactions, and they're ranked from top to bottom based on their relative return contribution. So fairly recently, Timberline, this first one up at the top here, was actually acquired or bought out. I think it may have been taken private, if I recall. Not held that long, held approximately a year in Tom's stock advisor portfolio, but oh, what a year. During a year when the stock market went up basically 6%, it went up 130% as a result of that M&A transaction. And you can see that it ranks at the very top of the list here with 124% relative return. As a reminder, any company that is shaded in this kind of tan or light yellow shading is a closed transaction where he's actually issued a intent to sell report. So you can see a number of companies that have actually been sold, and you can see that, like we were talking about accuracy a little bit earlier, these have all worked out pretty well. They're all in the green. Most of them, well, all of them are certainly positive returns, even during periods when the stock market has been a little bit dicey. Now, in terms of open positions, the best performing open position at this time is Berkshire Hathaway, the B shares, which he basically went into a month after Teradata, another company that we've been interested along with EMCE and a few of the storage type companies, but back in the teeth of the bear market during the Great Recession. And you can see both of those have actually done quite well, and they continue to be held. Netflix is another one that Tom has continued to hold through all of the turbulence. Netflix, as you know, went up into the mid-200s and has come back down and has now gained back several percentage points, looking pretty good over the long term. And then we'll talk more specifically, again, we'll get to Coach at the end, but here are those two positions, that $200 investments into Quality Systems, and you can see they actually go back to February 2003 and March 2003, and oh boy, anytime we can reel one of these in over nearly a 10-year time frame, again, we're talking about 20% per year for 10 years when we're looking at these numbers like this, and that's kind of a holy smokes moment. And keep in mind that Quality Systems has actually come back fairly significantly here over the last approximately 6 months. How much has it come back? Here's a look at the 10-year time frame, going all the way back to the purchase of Quality Systems back here. I would note that a number of us actually noticed this company back in this time frame also. I know that it appeared in the Forbes list of promising small companies somewhere in this time frame, that list that comes out in the Forbes promising small company list around Halloween every year. And I know a number of people, including many of you in the room, probably latched on to Quality Systems, if not here, sometime early in this picture. So a real nice picture, left to right, not exactly up and straight, but very strong performance over approximately 10-year period. As we mentioned, they have been going through a little bit of a dicey period. In fact, dicey enough that some people shared stories 2 nights ago of getting tired of the speed bump or the disruption, and they've actually gotten out of Quality Systems, hopefully waiting for it to slow down. As Lori described the other night, there's a bit of a disruption at the company with one of the members of the board, and he's I'm not sure what he's so upset about when I look at this chart and I look at what the company's looked like over 10 years, but he's engaged in a number of proxy battles and trying to take over the board, and like I say, I'm not so sure what he's so upset about. This company is firing on quite a few of the cylinders involved. A lot of words on this slide, but what I found interesting, again, if you're a subscriber, you can go back and actually take a look at the specific time when the companies were bought back here in February and March of 2003, and you can actually go back and see what was Tom looking at the time. And in response to a question about where he finds his stock ideas, we get a couple of interesting hints. First of all, he likes Investors Business Daily. I know there's some IBD fans here. I like them too. And he basically is searching for kind of a triple play situation with stock performance that's been kind of weakened, margins that may be down, and earnings may be weak in both. And then, importantly, at least from my perspective, he's also watching their message boards, their community. He once wrote an article where he considers the Motley Fool to be, if not the best, one of the best investment club experiences on the planet. And he wrote that for the pages of Better Investing magazine. So, again, he thinks of his enterprise as one big investment club. I think that's kind of cool. So, you know, he basically narrows it down to looking for the company that has the highest projected relative return. That's what he's talking about here. He calls it margin, but he's basically shopping the same way that we do, looking for the horse, so to speak, that is in best position to deliver a higher projected annual return. Now, also, he points out that he got the idea from a specific individual making a comment. Matt Ritchie, I've met him. I don't know him, but I've met him. And, you know, Matt just basically given him this story back in early 2003 about this interesting-looking company. So Tom dug in and figured out more about what was going on and, you know, ran into the record keeping. This is pre-healthcare reform by a few years. And then he talks about, you know, they're basically doing with smaller companies like Cerner does with the larger companies. And all this stuff has basically panned out very well for not just the stock advisor and Tom, but for many of us. So again, some very key things to take away in terms of sources of ideas, things that they look at, keeping an open mind and listening to the people around you. I think some of the best ideas come from all of you in the room, and don't be afraid to lean on that. Let's talk about some of David's best in the rule breaker portion of the stock advisor portfolio. As you can see, he's also got a home run up there at the very top. And I find that kind of interesting because he's notoriously loyal to the companies he picks. And in this case, he spotted Netflix back in May of 2003 and was willing to jump out just a mere 6 months later after the company had gone up 160%. During a period when the market only went up 16, so it ends up at the top of this chart. Pretty wild stuff there. We're going to talk about this one in greater detail. This is 3D Systems. It's one that is on the current recommendation platter by the stock advisors, and you can see that the fairly recent selection just 6 months ago of 3D Systems has so far knocked it out of the park. Apple, early on, not bad. He selected Apple on multiple occasions and added to it approximately a year ago, and over the past year it's gone up 80% while the market's gone up 6%, and I know that many of you have thankfully experienced that too. I absolutely love this one. By the way, anytime it says DL in here, it means that it's been delisted. Navtech, the company was actually Navtech, ticker symbol NVT. It disappeared from the planet. It was actually acquired by a European company and taken up for a considerable bump up in price. It's one of my favorite Salomon Select choices that we made. I believe we may have actually beat him to this one by a few months. And it's one of the better performing selections in the history of Salomon Select at Manifest Investing, and certainly nothing we can complain about here when it comes to 60% returns. See some other that have been taken out, but you see a couple more Netflixes. The thing I find interesting about David and Netflix is, you know, many of us, I believe, whether we are successful or have a less than pleasant experience with an investment, when we close it out, we often don't go back. It's almost like we're afraid to admit we might have sold it too soon, or all the pain of having to admit that we might have made a mistake, or our company might have made operating and executional mistakes. All that stuff is unpleasant. We don't often go back. Well, here is clear and present evidence that he's willing to go back, and it has delivered outstanding results since going back, despite the fact that, like I said before, it went up, you know, significantly and dropped off fairly significantly. Here's a look at 3D Systems. Again, it's a current favorite, and you can see that this is a current selection selected back in the early part of this year and then reselected again for the newsletter recently. This is kind of a fascinating company. This is one that I'm kicking myself over. I went to a chapter function in early 2012 where a group of chapter directors from the local chapter were sitting around talking about this fascinating three-dimensional printing. And I didn't know anything about the company at the time, but again, think back to what I just had to say about Tom Gardner and Matt Ritchie, and I should have listened better. And some of you in the room may actually have been there, because that was back right in this time frame here. And again, pay attention to the people around when they come up with a suggestion or an idea. And it doesn't mean run out and buy it. It means run out and study it and become familiar with it, because this is the type of thing that is possible when we listen to the people around us. So again, that's kind of a coulda, shoulda, woulda episode for me with 3D systems. Here's kind of an excerpt from the newsletter so you can see some of the stuff that David covers. Here's a description of the company. I have never seen this. Perhaps somebody here has a comment when we open up the floor at the end about actually witnessing some of this stuff. I actually want to make a point to go out. There have to be some companies here in the Detroit area that have this type of stuff, and I'd like to see it in operation, because I can't even imagine 3D printing. There are some videos on YouTube. I'll make a note and actually give you a couple of links. I know that we've done this in the past on the Manifest forum, but links to the YouTube videos. In fact, I think it's Jay Leno was talking about printing parts for his automotive collection of antique and collector's item cars. So, interesting company. It probably worth the time that we can put into it to understand it. Another feature that they do within the newsletter, and again, they're not paying me to say this, I just find this stuff interesting, is they walk you through some of the bullish type green flags and areas of concern known as red flags, the type of stuff that we would be watching, including some awareness of competitors, things that could go wrong, things that could happen with the company, and again, things just kind of be watching on both sides. So if you're a stock watcher for a company like this, they give you a little bit of a little bit of playbook to keep track of this kind of stuff. And one of the things I really like when I run into this type of analysis is we tell stories about George Nicholson, one of the co-founders of the National Association of Investors, and he used to go to the dog and pony shows of company representatives or analysts, and when they would come and make their multi-city tours, literally these dog and pony shows. And he was renowned or legendary for literally asking the first question from the group of Detroit analysts and professional money managers, and very often that question would be a very simple one: what is your greatest challenge? And he would listen to how they basically answered that question, and what he was always hoping for was an honest assessment of competitive threats. And what he was really hoping to hear is respect for competitive threats. So that's I like when I see this type of thing in a venue, educational venue like the Motley Fool, trying to serve that same type of purpose, because it's an important answer. He literally would decline to invest in a company if they were flippant about competition. I'm talking about Mr. Nicholson. So let's talk about some of the times when things haven't gone quite as well as planned or intended when it comes to some of Tom and Dave's selections. This is the other end of the spectrum. We're going to call it Tom's room for improvement. Now that room for improvement could be either a mistake made in the analysis by either Tom or David or their team, or it could be a room for improvement opportunity created by the management of the company that you own. And it could be any blend of either one, and they're both same result, bad things, and want to always be watching for these type of situations. Shuffle Master, back in May 2006, sold a little over a year later at a loss of 51% during a period when the stock market actually advanced 10% per year. So Shuffle Master checks in as the lowest relative return on the chart. This is one of the earlier selections for the portfolio. You can see it was reselected again not too long ago, and the company is H.G. Gregg. It's a retailer, and you can see they're having some hard times. In fact, I believe their stock price was $15 or $16 as recently as 2 or 3 days ago, and you can see that they've kind of zoomed to the top or the bottom of this dishonorable chart, as you can imagine. We'll talk a little bit more about Pacific Sun here in a minute, but you can see some of the experiences that were not quite so pleasant. one of my all-time favorite companies, the company that makes the synthetic materials for decks, known as Trex. We featured it in Better Investing magazine a few times, and maybe a case of some weaker timing here. But again, you see a fairly diverse group. Some financial companies here is Jefferies, disappointed for a while. Scott's Miracle-Gro, SMG. Might be a little bit early in that one to make any judgments, but you can see the track that it's been on so far. So let's talk a little bit about Pacific Sunwear. This is actually one of his most gut-wrenching experiences, and I really do think that there's a fairly powerful lesson here. If you see that they bought Pacific Sunwear back in that 2006 time frame on the left-hand side of this chart, and then basically it went south from there. The Wilshire 5000 benchmark is shown here in red, so you can see that it basically has been lagging and lagging and lagging until the point where Tom eventually gave up and removed it from the portfolio under those dire conditions in early 2009. And I think the major takeaway here was what you see here in this first paragraph. And again, what I find so refreshing, like Lori said at the beginning of the session, these guys are willing to go back and talk through what experience they've had, what lessons might be learned. And one of the major reasons that Tom was interested in Pacific Sunwear, we'll take a look at the fundamentals here in a second, was a name. And I don't know the name, but Seth Johnson, a 12-year veteran of Abercrombie & Fitch, and he apparently was influential and a pretty strong leader at Pacific Sun. And then notice that not too long after this point in time, he stepped aside and left Pacific Sun. And again, you hear us talk about this, but here's a perfect example. That was probably somewhere in here if I had to guess. I don't know exactly when, but as Tom said, not long after they initiated the position in this company. If you lose somebody like that, it might be time to really carefully reassess your position. It's certainly a condition, a dramatic condition that has changed, and so a change in management can be a reason to reassess your position, take a step back, and sell the company. On the flip side, I think we have a case today where I think it merits more attention. Yahoo. Yahoo named a very capable person as their CEO this morning, and it'll be interesting to see what happens at Yahoo. It's something we're watching fairly closely, and I made some comments about it in the forum. So a change in management cuts both ways. But in this case, I'll bet if Tom could do a do-over or a mulligan, he'd go back and say, hey, when Seth left, Mr. Johnson left, it was probably time to reassess our position. And here's a look at it in our terms, a look at the fundamental analysis, the business model for the company, and you can see that this was a fairly long-term track record, and whatever Seth was doing seemed to be working, and obviously we were hoping for a trajectory, something along these lines. And as is often the case, when you have a disruption like that, you get something completely different. Now we can sort of understand in the teeth of the Great Recession how some of this stuff was under a considerable pressure, but you can see that the company has not recovered. And as you may have seen in that previous note, the Motley Fool, Stock Advisor, and Tom Gardner have been trying to get communication established with the company so they can understand, how are you going to turn around, and they're basically not getting return phone calls or return emails. So that's why they walked away from it. But a fairly nasty situation, one that we may have been in tune to based on the business model analysis for the company. So let's talk about David's weak moment. David's weak moment, like many of us, many of you remember the days back in the late 1990s and just after the turn of the century when we had a bit of a Krispy Kreme fetish going on within our community. And in this case, from August 2003, Krispy Kreme Donuts, ticker symbol KKD, has taken quite a hit. You can see that they're down from 44 down to 4 and change. So they are in the spot of dishonor within the portfolio. And this one really does kind of fall into a David, what in the world were you thinking at the time? Maybe a little bit too much sugar on the brain or whatever. And others, I thankfully avoided this, but we have friends in the community that fell for the Krispy Kreme extravaganza or whatever you want to call it. It just didn't work out very well. We'll take a closer look at it here in a minute. Again, you can see a fairly diverse set of companies. I like this one down here at the bottom. It's one that I featured for the roundtable a couple of months ago. That's Southwest Airlines. Even though it's down since October 2010, I think as a non-core, longer-term play could still work out just fine. You can see it's still active. It's not closed out. Another one that's a community favorite, 2.6. It's down a little bit of late, but longer term, probably okay. I'd be surprised if it ended up here longer term. You can see another airline here that didn't work out quite so well. That's JetBlue. He gave it 3 years. I said he's generally pretty loyal to these companies. He gave it 3 years. Did not work out quite so well. Krispy Kreme donut. Here's a look at the value line chart. You can see that he basically dove into the serve 'em hot donuts back in that time frame, and it just didn't work out very well. We know the story now that they basically tried to grow kind of uncontrollably, had all kinds of issues. We'll just leave it at that. It's a big nutshell that they just had a whole bunch of issues and a whole bunch of blown opportunities, because this is a good company. It's a company that's been around since the 1930s out of Winston-Salem, North Carolina, and they've done some good business over time. They just got way too caught up in the frenzy and paid a heavy price for that sort of thing. You can see dropping from $50 price levels up here at the top down to $1 a share back in 2009 or so. So not nice, and one that, again, if he could have a mulligan, he'd probably go back and think about this one completely differently. And you can see that he's actually using the learning experience here, as he talks about, is to watch for vulnerability to this sort of thing in future case studies. Let's talk about some of the current opportunities on their current dashboards. Here's Tom's current dashboard for what we would think of as the rule maker component of Stock Advisors. And you can see these guys are having some issues. I would definitely wait and see how that one shakes out. You know, like I said, the price is probably down 50 to 70% within the last week. So it's time to figure out if is that number complete science fiction, and that will unfold over the next several days. You can see that it's down considerably from where Tom first put it in the portfolio. Companies currently probably of interest to Tom are companies that are up here towards the top of our sweet spot. I got to believe he's looking at Quality Systems thinking that the story is still intact, and that's a pretty good situation. So if you're looking for ideas for study going away from here tonight, that's probably one of them. And note that a couple very long-term community favorites are up towards the top of the list, along with, if you're feeling a little bit frisky, Netflix, even at a price tag of, it's all the way back up to 83 now. These could be interesting opportunities. Do note that Netflix is still considered to be pretty much a non-core situation, whereas both of these, Coach and Aflac, are generally regarded by most of us as a pretty reliable core situation. Here's David's current dashboard starting at the top. These are ranked, again, by the return forecast or the projected annual return. And I think if he's going shopping, boy, the top one on the list, if it's not overpowering your portfolio, many of us in the room have quite a bit of Apple in our portfolios, but probably worthy of study, even at a stock price of $600. Again, the stock price doesn't tell you what you need to know, and the PE doesn't tell you very much about what you need to know either. It's all of the things adding up in that jigsaw puzzle that we know as a fundamentally based stock study. Things look pretty good for this company. Even if the projected return here is a little bit higher than what some of us would project for the company, the projected returns are still pretty high, and in the case of Dave's portfolio, it is still only a 2 or 3 times selection, representing 5% of total assets in the tracking portfolio, so there's room for some more. Netflix maybe a little bit less room, but certainly attractive, and some fairly interesting companies up at the top. I already talked about Southwest Airlines as being also something worthy of a little bit of attention, and Priceline, even at this astronomical appearing stock price. Again, stock prices can be misleading. The quality and the projected return for the company are pretty strong. There's some other companies here, but again, I think you'd want to stay, and if you're out there searching for companies towards the top end of the sweet spot, perhaps giving consideration to the really high quality companies up at the top. Here's 10 companies that you can take away from here tonight. In their recent newsletter where they celebrated their 10-year anniversary, these are 10 companies that they basically said 10 companies for the next decade. They're worthy of study and at least comprehension across the board. Then there's some more core-like companies. There are some non-core-like companies. There's some innovators. When you take a look at these guys in the natural gas field, you take a look at these guys in the realm of investing, Wisdom Tree Investments, some real staples up at the top, Amazon, driving all of its competition crazy. Anyhow, this list of 10 companies are companies, whether or not you invest in them or not, they probably do belong in your field of comprehension and awareness. So let's kind of wrap things up with just noting that we often just say experience excellence, but let's flip it around and say talk about this as an excellent experience. Nobody's fool. They were recently featured in a number of publications. The Motley Fool was cited as a pretty good place to work, and you can see they appeared recently in Northern Virginia Magazine. I pulled these couple of quotes out of their 10-year anniversary issue. I think it really resonates with some of the stuff that we do. We talk about focusing on the fundamentals, understand the quality of the company, the fundamentals, the growth rate forecasts, your expectations for margins. You guys all know the milestones. That's what he's talking about here, but also try to develop a sense for the people involved in the enterprise. You know, coming right back to his example with Pacific Sunwear, when there was that fairly significant change in management, it's important to understand the people. In my example with Yahoo this morning, understand who this lady is. She was one of the most successful people at Google, and they basically have poached her away from Google and given her the CEO position at Yahoo. Understand who she is and where she might take Yahoo. But don't ignore the numbers. Don't ignore the numbers, but focus on them. Second, David, very similar comment. Invest in the company, and that includes the people, the story, their field of opportunity, not the numbers. Now, he's not suggesting that we ignore numbers. You know, he goes right on to say, understand their growth, their profitability, their valuation, all that stuff that we do, but try to seek out companies that really tend to be awesome companies. Now, how far is that from the advice of do an industry study, invest in the best of the best? I would say that's dramatically consistent with where we try to be in our search for companies. And then a little bit of fun here at the bottom. In their 10-year anniversary, Tom and his team basically threw down the gauntlet and said they're going to trounce Dave over the long term. They just need more time. And I did paraphrase here a little bit, but this would reflect his childlike, energetic, competitive spirit. Bring it. And I think that's a fairly valid thing. I did put the Olympic podiums up here. I do think that Tom and David would, you know, basically in celebration of the Olympics say, okay, if we're standing up there on that top podium among some of the top performing investing resource newsletters out there, we need a big podium, because it's not just Tom and his brother Dave. It's the group of people, the analysts, and all the people involved at the Motley Fool that belong in that top podium, and it would be a big podium. So some good, clean fun, and hope you enjoyed that review. Let's go ahead and open it up for any questions or comments. Love to hear of anybody's awareness or any experience with the Motley Fool. And do we have any items of interest or conversation, Lori?
Okay, hold on a second.
I'm going to go back to the list of interesting companies in case any of you want to scribble those down.
Somebody was asking, Laura Scott is asking, what's the average holding period on their stocks, and do they have any criteria for selling? She wanted to know why they held on to Krispy Kreme so long when it was nosediving.
Interesting. I haven't calculated the average holding, Laura, but I will, and I'll post it in the minutes of this along with the PowerPoint, so I'll do that. It will be kind of interesting to see what the average holding period is between the two brothers. So I'll take a look at that. I don't know. I suspect it's going to come out fairly even and probably a little bit longer holding period than most people would instinctively expect. And what was the second part? As far as the selling discipline?
Yeah, and
yeah, it's interesting. As I was looking over some of these and pulling up some chronicles, and I don't know, I might send them a couple notes from time to time. And here's what I'm thinking. I'm with you. I think in the case of let's go all the way back to the biggest holdings in Tom's portfolio. There's some companies up here at the top, and if we subject them to our discipline, that maybe those are candidates for sale. It'd be kind of interesting to send Tom a note, with the dashboard, focusing in on the lowest projected returns, perhaps include a dash of relative strength index or whatever, but basically pose the question, could you improve performance by watching this a little bit closer? Some of you have heard me in the past talk in greater detail about the difference between a stock picker and a portfolio manager. I can point to a number of extremely gifted stock pickers out there in the investing world who apparently are not as gifted when it comes to selling. And I'll just leave it at that. I think it's the type of thing that developing that sell discipline, I'm not saying they don't have one. I mean, they actually do. I'm just wondering if perhaps we couldn't augment with some of the stuff that we think about and flag some of them. Anybody else is welcome to chime in if you have any thoughts along those lines. Any other comments?
Roy Chastain said, you put them in a much better light than I had placed them in. Time for me to eat crow.
Really? That's interesting. I wonder if Roy's got a microphone, if he'd be willing to. Roy actually brings up a good point, because I think we all tend to develop perceptions about things. Lori and I were talking about a couple of different newsletters and people who generate newsletters, and you get these perceptions, and when you really hold their feet to the fire and measure their individual transactions, again, very few people in the investing world do this. I would cite Barron's as an example of somebody who actually does it a little bit better also, and I respect them for that same reason. But you put the emotions and perceptions aside and look at the facts, and sometimes they can be counterintuitive or that sort of thing. So I'm with you there, Roy. I've actually experienced that with other sources. And in fact, I wouldn't be the least bit surprised. You can write this down. Tom's coming out of that 10-year of the lost decade. I expect the performance from Tom to challenge Dave, and I expect them both to go up going forward. Again, they've been through a tough time. If you think about what's happened to Netflix and what's happened to Quality Systems, Coach for that matter, and you start looking at some of these larger holdings and what's happened to them, they've actually been dinged pretty good here within the last, let's say, within the last 9 months to a year. And
even less than that, practically.
Yeah, some of them are less than that. So thanks for the comment, Roy. Anything else? Again, go ahead, Lori.
Bill Thompson is asking if you had made a similar review of the investment advisory report from ICLM.
I keep track of a lot of investment newsletters. If you'd like to see a certain newsletter, and again, let's just reinforce something I said before we got started, or as we got started. If you found this to be informative or a source of ideas or however you want to frame it, I'd love to hear your feedback. And if you do have, I don't want to turn into Mark Holbert, but Mark Holbert's a friend of mine, but I don't mind digging in and figuring out and looking for stuff that works. In fact, it's going to be a big part of our Legend series that we're going to try to put together here over the next few months, Hugh McManus and I, where we take a look at specific performance. And if you've got a newsletter in mind that you'd like us to take a look at, again, we don't want to get away from doing the clubs, but every 3 or 4 or 5 months, if you've got a professional portfolio or a resource that you'd like us to take a look at, suggest away. And you can send that suggestion to either Lori or myself. Let me go back to the cover slide here, and we'll celebrate a little bit more. My email address is on there, along with my Twitter. Any of you Twitter people out there can contact me through that at Manifest Invest. And Lori's email address is lori@bivio.com. So if you have any suggestions or requests, we would look forward to hearing that.
I think it's interesting that, you know, of all the clubs we've looked at some clubs that, you know, certainly are in the same ballpark as these guys in terms of picking stocks.
Yeah, and I think we have to continually remind ourselves of how exceptional that is.
Yeah, I do too. I think that's pretty amazing.
You know, you and I have both worked with clubs that, you know, are in that. Well, we've actually worked with clubs who were disappointed with positive 4% relative return. You know, 400 basis point advantage to the benchmark, and they're ready to all commit harry-carry, and we're like, what are you guys talking about? You know, and then we've also dealt with clubs that have a slightly negative relative return. And again, just going back to the picture, keep it in context, people, please, please, please. If you're not down here with these guys, the average investors who we know we got to be better. If you can't be better than that, and that's a -5 percentage point relative return, then you probably should be doing something different. But if you're at -1 and you're somewhere here in this range, like somewhere in here, down around 1 or 2% negative, and you're just getting started, I forbid you from being discouraged. You know, I mean, it's
yeah, I think a club is about learning to do this. You don't just start out at the top. You might be lucky, but if you're up against people that have been training and doing it for years, that's a little different.
Yeah. And again, the big message is to keep it in. First of all, understand, you know, use your Bivio benchmark report to understand where you are on this picture, and then act on it properly. Either maintain or augment what you're doing, or, you know, understand where you're at.
I think that's a really important point. One of the important things is just to be measuring where you actually are, because you're never going to make any progress if you don't know where you are. And wherever you are is fine. You know, again, it's about learning to get better. So, you know, you should look at where you are, and you don't have to beat yourself up about it. It's pretty hard to do well at this, but...
By the way, I did run into another performance point just the other day of somebody I have deep respect for. I've met and spent a little bit of time with him, John Neff of he's now retired, Vanguard Windsor Fund. He claims over his total collective investing, and again, professional, one of the best in the world, over a 50 or 60 year time frame, to probably have a +2, maybe a +3% relative return. We're talking his total investing experience. But when you take a look at the Vanguard Windsor Fund over, I believe it's either 32 or 36 years, the relative return of that fund under his stewardship was +7% relative return. And that's just, you know, out of this world. And again, for the type of thing that we want to take the legends of investing, explore what they did, how they did it, why they did it, and how, you know, and specifically what were the results, and see what we can learn and how it applies to the type of investing that we do. Pretty excited about that sort of thing.
Mary Wrench would like you to do Dashboard Diagnostics on the roundtable portfolio and bring it down to 15 stocks.
Dashboard Diagnostics on the roundtable? Oh, boy.
How many stocks do you have in that now?
I don't know. A lot.
Oh.
Thanks, Mary. We probably will do some whittling here in the next few months. Any other comments or questions at this point?
The focus of that has been more individual stocks, hasn't it, than
well,
necessarily a portfolio management.
Right. But as you've seen here tonight, you know, even though there's not actually a portfolio known as either the rule breaker or rule maker, we built a tracking portfolio. But it really does come down to, we do the same thing for Challenge Club, for Roundtable, of keeping track of every single transaction, month by month. And by the way, you guys will be elated to know that the audience is still winning, and Ken Cavula is in second. Well, he actually might be in third behind Nick Strategos and the Damsels, Ann Manning and Kim Butcher. And don't ask where I'm at in the standings. All right. Well, we're a little over an hour. I think we can probably go ahead and wrap up. We will stick around. I would like to make everybody aware that tomorrow night, you guys are having a session tomorrow, right, Lori? Go ahead and talk about your online.
Actually, it's going to end up being tomorrow afternoon at 4 p.m. Eastern Time. We are having, a Cool Club session, so we're going to be talking about covered options. And we have a really interesting example this week. It's going to be Fastenal. So that's a stock I know a lot of people have an interest in, and it's a really interesting case study for using, in this case it was a cash secured put. So we've got a website now for the Cool Club, www.bivio.com/Cool Club. You can follow how the option we talked about last week is doing right on the home page. And if you're interested in options, I think you'll be really interested in talking through. And we will be recording. We realized 4 o'clock Eastern Time is not the best for everybody, but we're kind of moving meetings around because we're meeting every week, and we're trying to cover everybody from coast to coast.
And I did also want to bring everybody's attention to 2 Tuesday nights from now. We will be having another gathering of the roundtable, and I'll just whet your appetite here a little bit. We've been doing this now for 2 years, and if you'd been with us 24 months ago on that evening, the 4 selections were Lilly, Stryker, Abbott, and BioReference Labs. And the 4 of them have gone on to achieve a 14.9% annualized return and a positive 4.4% relative return. So I guess the wheels fell off after that, but I'm just teasing you with the companies that we selected 2 years ago, and we do keep track. Very elated with those 4 selections and how well they've done. So join us to see what 4 selections may come up. That's 2 Tuesday nights from now. There will be it'll be on Manifest Investing events and available here shortly.